Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at VCX.
If you find our talks useful, please consider subscribe, like, and comment underneath. And hey, before we get started, the VIP Algos link is below in the description, so make sure to check that out for some top-tier trade insights.
Absolutely. So, let's just get right into it because today's topic is, well, it's wild. Imagine, logging into your brokerage account and just happily paying $173 for a $20 bill.
Right. I mean, objectively, it is just terrible math. You would never, ever do that in line at the grocery store.
No, of course not. But over the last 3 months, thousands of investors have been doing exactly that with this public ticker, VCX.
Which is crazy. And, the most fascinating part of this whole phenomenon is that those investors aren't necessarily wrong to do it. So today is mid-June 2026, and we are looking at an asset that has basically completely broken the standard models of how retail investors value a company.
Yeah, it really has. It's the perfect subject for our talk today. The mission here is to sort of unpack the actual mechanics driving VCX's extreme volatility. We're going to look at the underlying data to figure out if the stock's current price is just, a massive retail bubble waiting for a pin, or if it is actually a brilliant, misunderstood gateway to the whole artificial intelligence boom.
Because if you're listening to this, you have definitely read the headlines about these massive private funding rounds for companies like OpenAI or Anthropic or SpaceX.
Oh, yeah. Constantly in the news.
Right. And you've probably asked yourself, well, how do I get in on the ground floor before the IPO? Before Wall Street marks it all up and sells it to the public. Today, we are analyzing a fund that exists to solve that exact problem.
Exactly. And to understand the massive premium people are paying for VCX, you first have to understand the structural moat it operates within. Because historically, the pipeline of wealth generation in tech has fundamentally shifted.
Shifted how?
Well, if you look back at the late 90s, right? A company like Amazon went public very early. It debuted at a valuation of around $438 million.
Wow. That seems so tiny now.
Right. But that meant the average retail investor could buy shares on the open market and actually participate in the massive 10x, 20x, 50x hypergrowth that followed.
But that just does not happen anymore. Today, a company like Anthropic or Stripe, they just stay private while their valuation balloons from $1 billion to $50 billion or even $100 billion.
Precisely. And that's because the private capital markets have become so incredibly massive. Founders don't need to endure the regulatory headache of a public IPO to raise capital anymore.
Yeah, why bother with the SEC filings if you don't have to?
Right. So by the time these modern titans finally hit the public markets, all of that initial hypergrowth has already been captured by the institutional giants. The SoftBanks, the Microsofts, the sovereign wealth funds.
So all the meat is off the bone by the time regular people get a chance.
Exactly. Getting late-stage, pre-IPO shares of these unicorns was legally and financially restricted. You needed to be an accredited investor, and you needed tens of millions of dollars just to meet the minimum buy-ins.
So the velvet rope was firmly across the door. And what VCX does is essentially democratize that access.
Yeah, that's the whole pitch.
It operates as a New York Stock Exchange-listed, closed-end public venture fund. You don't need a fancy invitation to a Sand Hill Road venture capital firm. You just open your standard brokerage app, type in the ticker VCX, and hit buy.
It's that simple. It gives everyday buyers two really critical things. First, exposure to a diversified basket of the world's most elite private AI companies. And second, and honestly more importantly, liquidity.
Right, because there are other platforms out there attempting to democratize private equity. Fundrise is a notable one, but they generally require multi-year capital lockups, right?
Yeah, exactly. Your money is basically stuck in the fund while the investments mature. But VCX, it trades on the open market every single weekday.
I want to look at the actual balance sheet here because when a stock is moving as violently as this one has, you want to make sure the foundation isn't built on sand. And the analysis shows VCX actually has a surprisingly stable balance sheet.
It really does.
They are sitting on $678.9 million in net assets. And their leverage, the money they've borrowed, is remarkably low. It's listed at just around $15.8 million in reverse repos.
Which is a very specific low-risk mechanical tool in this context. I know a lot of retail investors get nervous when they hear a fund is using reverse repos.
Oh, absolutely. It sounds like Wall Street jargon for risky debt.
Right. But here, it is simply a bridge for capital calls.
Okay, break that down for us. How exactly does that reverse repo work for a venture fund?
Sure. So when a private company like OpenAI is putting together a massive new funding round, the timeline can be extremely aggressive. They might tell their investors, hey, we need your committed capital for this round wired by Friday.
Oh, wow. Just a few days' notice.
Yeah. And VCX can't necessarily wait for its own retail investors to buy more shares to raise that specific cash in 3 days. Instead, VCX uses a reverse repo. Basically, they pawn some of their safe, highly liquid assets, like treasury bills, to a bank for a few days to get instant cash.
I see.
They satisfy the OpenAI capital call immediately, secure their private shares, and then they just unwind the repo a few days later using their organic cash flow. It's a purely logistical mechanism. It's not speculative borrowing at all.
That makes total sense. It's operational grease, not risky leverage. So the actual mechanics of the fund are solid. It's a liquid, accessible vehicle holding some of the most coveted private tech assets on the planet.
Yeah, fundamentally, it's a very sound structure.
But, whenever you introduce unprecedented access to a highly anticipated market, human psychology just completely takes over. Which brings us to the boom, the bust, and the mathematical paradox we started this conversation with. Let's walk through the timeline, because it is nothing short of breathtaking.
Breathtaking is the right word. It is an absolute masterclass in market euphoria and, frankly, the dangers of price discovery in a new asset class. VCX had its IPO on March 19th, 2026.
Okay.
And it debuted at a very reasonable $31.25 per share.
So that was just about 3 months ago. And almost immediately, the retail trading community found it. Forums like Reddit's Wall Street Bets grabbed hold of the narrative, right? They started dubbing it the public ticker for private tech.
Exactly. And the momentum just became entirely self-fulfilling. In a matter of days, literally days, the stock surged 750% to an all-time peak of $575 a share.
That is just incredible.
Correct.
But it wasn't based on anything tangible, right?
Not at all. The buying pressure was completely disconnected from the fund's actual holdings. People weren't pricing the underlying assets anymore. They were pricing the scarcity of the access itself. It was a classic speculative frenzy where FOMO just overrides any traditional valuation model.
But the market always demands a reckoning eventually.
Always. Extreme overbought conditions set in. And then a well-known short seller Citron Research published a highly critical report on the fund's valuation.
And that served as the pin to pop the balloon.
Oh, big time. It triggered a massive 59% single-session plunge on March 26. Just complete capitulation. The stock has since sort of settled and is now trading around $173.
Which still represents a 68% crash on the peak.
Mm-hmm.
Now, from a structural standpoint, that kind of violent drawdown washes out the weakest, most highly leveraged speculative hands, right?
Yeah.
It attempts to establish a new, fundamentally driven base.
Yeah, that's the theory. The market clears out the tourists and finds a real floor.
But this is where I really have to push back, and where we return to that $20 bill analogy. You just said this fund has roughly $678 million in net assets.
Right.
So if you break that down per share, the net asset value, the NAV, which is the actual worth of the private shares VCX holds, was officially reported at just $18.97 per share.
Yep, $18.97.
So even down here at $173, the stock is trading at roughly 9 times its underlying value. I mean, I don't care how revolutionary the AI tech is. Aren't investors just playing a incredibly dangerous game of musical chairs? Why would any rational market participant pay $173 for $18 worth of assets?
And that is the exact question short sellers are screaming from the rooftops right now. It sounds insane on its face. But to understand why buyers are still stepping in at 173, we have to look at the core thesis of the bulls.
Okay, I'm listening.
It comes down to an arbitrage of time. That $18.97 NAV, it is not a real-time reflection of value. It is essentially a stagnant time capsule.
Explain the mechanics of that. Why is a public stock's value lagging so far behind reality?
Well, it's the fundamental difference between how public and private markets are audited. If you own a share of a public company, like Apple, that asset is marked to market every single second the exchange is open. You know its exact value down to the penny at 2 o'clock on a Tuesday.
Right. The ticker is constantly updating.
Exactly. But private venture funds hold illiquid assets. They only update the official value of their holdings quarterly. And that's usually based on internal audits or newly completed funding rounds by the target companies.
Ah, I see. So that $18.97 NAV is a snapshot taken at the end of the first quarter. March 31st, 2026.
Yes. And in the artificial intelligence sector, a 3-month lag might as well be 3 decades.
It's almost like looking at a star that is 3 light months away. The light you're seeing, that $18 valuation, is from March. The star has already gone supernova with new funding, but the public market's official paperwork simply hasn't seen the light arrive yet.
That is a phenomenal way to visualize it. I love that. Because since that March 31st snapshot, the underlying companies in VCX's portfolio have completely exploded in value. The data details some staggering numbers. Like, OpenAI recently closed a $122 billion funding round.
Wow.
Yeah, putting their post-money valuation at an astonishing $852 billion.
And they are reportedly generating $2 billion in monthly revenue right now.
Exactly. And Anthropic is on a very similar trajectory. They closed a Series G funding round at a $380 billion valuation back in February. And the current analysis notes they are already in talks for a follow-on raise, eyeing an $850 to $900 billion valuation.
So when companies of that size double or triple their valuations in private rounds, the funds holding those shares see a massive organic expansion of their balance sheet.
Bingo.
So how does this solve the math problem of the 9x premium, though?
Because the denominator of that equation is about to change. At the end of this month, June 2026, VCX will close its second quarter. They are legally required to mark their positions to market. They have to update the value of their OpenAI, Anthropic, and SpaceX shares to reflect all these massive new funding rounds.
Yep.
Analysts are projecting that the official NAV will surge upward, potentially to $30 or more per share.
Okay, let's look at the math on that. If the stock price stays flat at $173, but the underlying assets jump from $18 to $30, the premium compresses dramatically from the bottom up.
Yes.
The stock doesn't actually have to fall for the valuation to become more reasonable. The fundamental worth rises to meet it.
Exactly. And this ties into a much larger macroeconomic theme. The analysis cites a Q1 2026 letter from Fundrise, which categorized the shift toward AI infrastructure as a secular trend larger than anything we've seen in the past 100 years.
100 years, that's a bold claim.
It is, but they backed it up by highlighting that OpenAI has scaled to 900 million weekly active users. This is not purely speculative hype anymore. It is a fundamental, foundational shift in global computing demand.
So the bulls are basically saying, yes, we are paying a premium, but we are paying a premium to ride the biggest secular wave of the century. And we know the NAV is going to catch up to us at the end of the month anyway.
Exactly. The bulls view the premium as an acceptable admission fee to a market that is otherwise physically impossible to access.
Okay, so the math makes sense if you assume AI growth is bulletproof and that the new NAV valuation actually holds. But we have to look at the downside here.
We do.
Because if I'm buying a closed-end fund at a massive premium, I'm essentially tying myself to the mast of a ship right before a major storm hits. We need to ensure you, the listener, understand the very real structural threats looming over VCX right now.
Let's talk about the bear case, specifically lockups and gravity.
The structural risks really cannot be overstated. The first is pure valuation risk. Let's assume the bulls are entirely right, and the upcoming audit pushes the NAV to $30. Paying $173 for $30 worth of assets is still paying nearly a 6x premium.
Right, which is huge.
Historically, a 2x premium for a top-tier closed-end fund is considered incredibly generous. If the broader market suddenly experiences a macroeconomic downturn, or if sentiment around AI cools even slightly, the market might just re-rate VCX to that historical 2x premium.
And a 2x premium on a $30 NAV means the stock price would plummet to roughly $57.
Yeah.
That is a 67% downside from its current price, even if the underlying AI companies continue to do well. The air underneath this stock is incredibly thin.
It is very thin. But, the valuation risks might actually be the lesser of two evils here.
What could be worse than a 67% drop?
The second, and much more tangible threat, is a massive supply shock on the horizon. The analysts highlight a very specific date circled in red marker on every calendar: September 2026.
The lockup expiry. With the September lockup looming, we aren't just talking about a few corporate insiders or venture capital firms taking calculated staggered profits.
No, not at all.
We are looking at a supply shock of over 100,000 retail accounts who bought in at the IPO.
And the psychology behind those specific retail accounts is what makes this so incredibly dangerous. Retail investors do not behave like institutional algorithms. They are emotional.
Well, just think about the internal monologue of those early buyers. Even after watching the stock crash violently from 575 down to 173, these early investors who bought at the $31 IPO price are still sitting on roughly 84% cumulative gains.
Which is life-changing money for a lot of people.
Right. They have been staring at those unrealized profits in their accounts for 6 months, completely unable to touch them. The psychological pressure to dump those shares the absolute second the lockup expires will be unprecedented.
It's going to be a stampede.
Exactly.
Yeah.
So if you're holding this stock at 173 today, you aren't actually investing in AI anymore. You're betting purely on the psychology of the market in September. You have to ask yourself, am I stronger than 100,000 retail traders rushing for the exact same exit door?
And that is the exact game theory chaos that short sellers are counting on. However, it's really worth noting how long-term value investors are viewing this impending event.
Oh, how are they looking at it?
Rather than fearing the September lockup, many institutional analysts are betting that the 68% crash we already saw acted as a necessary clearing event. Their thesis is that the weakest hands have already been washed out.
So they think the worst is over.
Sort of. When the lockup expires, yes, there will be volatility, but they view it as a transitionary phase. Once those early retail investors take their profits and leave, the shareholder base can finally transition from short-term momentum traders to fundamental long-term holders.
But surviving that transition requires an absolute iron stomach. So let's look past the turbulence. Let's say you hold your breath, you endure the premium compression, and you somehow survive whatever supply shock hits in September. What is the ultimate payoff for holding VCX over a multi-year outlook? Say, a 12 to 24-month view.
This is where the underlying business strategy of VCX becomes highly compelling. The fund isn't just passively sitting on equity shares of OpenAI and Anthropic, just hoping the line goes up.
What else are they doing?
They are actively redeploying the capital they've called from investors into hard AI infrastructure, specifically data centers and the immense power grids required to run them.
So they're buying the physical picks and shovels of the AI gold rush. But how does a venture fund secure reliable yields on something like a data center?
Well, they aren't just buying common stock in these infrastructure projects. They are structuring preferred equity and debt deals directly with the facility operators. The data shows they're securing priority returns of 10 to 14% on these plays.
Wait, 14%?
Yeah. And because they are holding preferred equity, VCX gets paid its yield before any of the common shareholders see a single dime.
That is a very crucial detail. It acts as a financial shock absorber for the entire fund. It provides a reliable, high-yield cash flow mechanism underneath all those highly volatile, speculative venture bets.
Exactly. It really limits the downside. But the massive speculative catalysts, like the events that could trigger a realization of that massive premium, are the impending public debuts of the underlying companies.
Right. And analysts mention some absolute titans preparing to make moves. Bloomberg is reporting that SpaceX is laying the groundwork for a $75 billion IPO. Furthermore, Anthropic is reportedly eyeing a $60 billion public debut as soon as October 2026.
And if either of those top holdings successfully goes public, it changes the entire dynamic for VCX.
How so?
Suddenly, those opaque, quarterly audited private shares become highly liquid, publicly traded shares with daily price discovery. DCX could potentially unlock massive realized gains. They capture the venture multiple while the company is private and growing aggressively, and then they capture the public market liquidity premium once it IPOs.
Wow. So holding VCX right now is really about enduring the volatility of the structural premium to secure a seat at the table for the biggest liquidity events of the decade.
That is the calculated risk. It is a highly asymmetric bet on the future of financial market structure just as much as it is a bet on AI.
Okay, let's pull all of this together and summarize the core takeaways from our analysis today. The data gives VCX a bullish score of 7 out of 10.
A strong score, definitely, but one that clearly leaves room for the severe structural risks we discussed. The core thesis is that VCX is an unparalleled, fully liquid gateway to the world's most elite private AI giants. There is simply no other way for an average retail investor to buy a single public ticker and gain immediate exposure to OpenAI, Anthropic, and SpaceX.
But that access comes with a very steep price. If you are looking at this, you are navigating the extreme volatility of a high-premium closed-end fund. You are paying significantly more than the current net asset value, betting that the upcoming quarterly mark-to-market adjustments will expand the underlying value organically to the arbitrage of time.
And crucially, You have to be willing to weather the psychological gauntlet of the impending September 2026 lockup expiry, which will undoubtedly introduce a massive supply shock to the stock price as 100,000 retail investors finally gain the ability to sell.
But if you possess a multi-year horizon and can stomach the ride, it presents a very compelling entry point into the foundational infrastructure of the artificial intelligence boom.
It really forces us to step back and examine the entire financial ecosystem.
It does. And as we wrap up this talk, I want to leave you, the listener, with a broader thought to mull over. We opened by talking about that velvet rope, the historical barrier between retail investors and pre-IPO institutional wealth. VCX is actively attempting to cut that rope.
And if they succeed, it raises a really profound question about the future of capital markets. If artificial intelligence truly is a once-in-a-century secular shift, and everyday people can successfully access its hyper-growth phase through liquid vehicles like this, will the traditional Wall Street IPO model just become completely obsolete?
That's the billion-dollar question. If funds like VCX become the new standard providing massive liquidity and access to companies years before their public debut, we might be witnessing the end of an era where institutional giants get to hoard all the early-stage tech wealth for themselves, leaving only the mature, slower growth scraps for the rest of us. If the velvet rope falls permanently, what does the VIP club look like tomorrow?
It's definitely something to think about.
Absolutely. Well, that wraps up our daily stock analysis and catalyst talk for today. If you find our tops useful, please consider subscribe, like, and comment underneath. And remember, the VIP Algos link is below in the description, so be sure to check that out to level up your wealth building. Thanks for joining Smart Wealth with Joshua.